So what does an historic decline in stocks tell us about recession risk given Trump's tariff package? So I don't need to tell you the stocks have been extremely volatile since President Donald Trump announced his comprehensive set of tariffs on April 2nd, or the so-called Liberation Day. In the Thursday and Friday that followed that was the worst back-to-back day of losses in the S&P 500 since March of 2020 during the onset of COVID. And then if you go back before that, it's the worst since October of 2008 during the throes of the great financial crisis. And so that puts into context just how severe of a change Wall Street views this tariff package to be. Now, one fair question is, well, why is it such a surprise? I mean, Trump has been talking about tariffs all on the campaign trail in the early part of his presidency. Certainly, we've even recorded several videos about tariffs. So clearly everyone kind of saw some kind of tariff coming. But there's a few reasons why this did catch Wall Street by surprise. The first is just the degree. So Trump had talked about on the campaign trail about maybe universal tariffs of something like 10%, with perhaps more punitive tariffs on China. This goes way beyond that. So on average, our trading partners are looking at something like 23% tariff. So just right there, the severity is much larger. I'll highlight the European Union just as one example, someplace where prior to this, the US had fairly low tariffs. That tariff has been hiked to 20%, which is going to decrease trade between the US and the European Union quite significantly. The US exports 2.3% of our GDP to the European Union. So put it another way, that means we get about 2.3% of our national income from exports we send to the European Union. And so, that's going to decline, and that alone will have a pretty large impact on economic growth. You multiply that times the rest of our trading partners, and you get a pretty meaningful change. The other thing that maybe isn't as obvious but is at least as important is that Wall Street assumed that Trump's tariff strategy was all about negotiation, and so we heard this from several of Trump's advisors, including Treasury Secretary Scott Bessent during the campaign and in the early part of the transition. And it even looked like that from Trump's actions. So when he put tariffs on Mexico and Canada and then walked them back after those countries gave some concessions, this bolstered Wall Street's view that Trump intends this to be a negotiation tactic, just get better trade arrangements for the U.S., and then therefore any tariff would be relatively short-lived. Now he's much more talking about these being a permanent fixture, that these having this long-term resetting of trade conditions around the globe, which has Wall Street completely rethinking how long these things might last. Now, I'll start by saying that I do think now a recession is pretty likely. So I think firms are likely going to be frozen in a lot of their decision making by the uncertainty wrought by tariffs. It's not just that, even though maybe now you know how much it's going to cost you to import a good for sale or import a part for sale, companies have pretty complicated supply chains. And so while you might know what goods you're getting from Vietnam or from Mexico or from the European Union, you might not know where your suppliers are getting goods from or where they're getting certain parts within their supply chain from. And so I think a lot of companies are going to have to just wait and see how much their costs go up, how much they can raise prices domestically in order to continue to make a reasonable profit, et cetera. And so usually when companies are faced with this kinds of uncertainty, they slow down on spending, they slow down on hiring. That is a kind of classic textbook reason why you might have a recession. I'll highlight that in this period of time, the hiring rate among companies was actually pretty low, especially low relative to a normal expansionary period. But the layoff rate was extremely low. And so this is why we kept having pretty good jobs numbers, even though the hiring rate wasn't all that high. Well, the flip side of that means that if the layoff rate only rises a little bit, we'll get into negative job gain territory. And again, that's usually how we describe what a recession is. Now, in part because of this recession risk, but also because of kind of the likelihood that consumer prices are going to rise, Wall Street does not think tariffs at this level are sustainable. So if for no other reason than political pressure is going to build both on President Trump and Republicans in Congress to make some kind of action. Already we've seen Texas Senator Ted Cruz say publicly that he felt that if there was a recession and if prices rose, that the midterms could be a quote-unquote bloodbath for Republicans. Remember, Republicans have very thin margins in both houses of Congress. And so they're all going to worry about losing their own jobs as congresspeople, but also the Republican majority, and therefore how that would harm their ability to enact Trump's agenda. And so I think at some point, I don't know if that's today, tomorrow, or months from now, there's going to be some pressure to back off these tariffs as we start seeing more economic ramifications. But that could take a while, and there could be a lot of market action between then and now. Another big point is about the Fed. While it is true that tariffs probably will raise prices in the short term, I think it's actually likely that the Fed will start cutting rates before too long, especially as job growth turns negative. I think that's because the Fed will see that while there's sort of a one-time increase in price due to tariffs, that after that, the effect of a weaker economy will take over, and then the ongoing inflation rate from that point might actually be a good bit lower. And so I think you will see the Fed cut, but there's been talk about, well, the Fed needs to do an emergency cut given all of this market tumult. I don't think the Fed is inclined to do that at all. In fact, I think the Fed wants to see some very clear, hard data suggesting there's a significant economic slowdown. I don't think they're going to kind of front run it and anticipate it. I actually think that would open them up to accusations of being overly political. And so the next Fed meeting is May 7th. There's a decent chance they might cut at that meeting, but they might not even cut that meeting. They might be waiting for even more data before deciding to do so. So I wouldn't look for the Fed to rescue the market in the very, very short term, but they could become a pretty important factor in the more intermediate term, which I'm going to get to in a second. So with that, let's talk about what might come next for stocks. First thing I'll say is kind of an organizing thought is that moments like this, the stock market is going to have big moves both up and down. Okay, so I think that when you talk about trying to time the market, how difficult that is, a big reason for that is that during down periods, you get often really gigantic rallies, especially in the moment that things turn around. And so getting the timing of those moves right is extremely difficult. Remember that it's not a bottom because there's suddenly good news. It's a bottom because everybody thinks the news can't possibly get any worse. And so it always feels bad in those moments. To highlight how much the market could suddenly rebound, how these things might happen, I'm recording this on Monday, April 7th. This morning, about 10:15 a.m., Trump posted something on Truth Social. Then that was followed up by a rumor that maybe that there could be a pause in the tariff. So Trump was talking about negotiating with Japan, and at the same time, this rumor starts circulating Wall Street that there could be a pause in tariffs. And that set off a 2,000-point rally in the Dow in a span of 15 minutes. Okay, and so it just shows you that if Trump does something to pull back from tariffs, even something fairly minor, there could be a truly epic rally. And so just be extremely careful with things like, I should pull out of the market. You could get that timing extremely, extremely wrong. Now, There's a number of other things I would say that could be positives coming up. Now, I know it sounds naive to talk about positives after I've just spent a whole video talking about risks, but a good investor thinks about balance, thinks about what could go right and what could go wrong. And so I want to articulate these things. I already mentioned the possibility that the political pressure builds up and Trump pulls back from tariffs, which I think is eventually likely. I just don't know what the timing of that is. The other thing that could definitely happen is if the Fed is able to cut rates and is able to therefore bring mortgage rates down, there's definitely a possibility of a stimulus coming from a kind of revival of the housing market. We wrote about this in our article about the Fed, so you can check that out on the Facet website. But the housing market has been very moribund. This could, if interest rates could drop enough, it could touch off a lot of refinancings and a lot more existing home sales activity. And that could be a pretty good tailwind for the economy. The other one is that there are tax cuts probably coming, and all of this market concern could put more pressure on Republicans to pass a larger tax cut. And whatever you think about the tax cut, it certainly would be stimulus to consumer activity and therefore could be a positive for the markets. All right. And so, look, I'm definitely not saying that I know where the bottom is or that this is the bottom. I don't know that. But I do think that the market is already down around 20% from its highs if you just look at the S&P 500. And that kind of decline is consistent with a mild recession. So it could certainly be that we've already priced in enough fundamental economic weakness to account for even a recession. And so I'll leave you with this idea that once the market prices in an event or an impact, then there's no reason for the market to continue to decline. And so right now, that's the process we're in. We're trying to figure out how big is this tariff impact? How much of a decline in company profits will it cause? And therefore, what is the right price for stocks? And that kind of price discovery process is what we call it, can take time and can be painful while it's happening. But at any moment, we could be there and we could have had that priced in. And a 17, 18% decline certainly says we've priced in a lot of that effect already. And so again, not saying I know where the bottom is, but I am saying that we have a sense that there could be a balance of risks here between things that could go right and things that could go wrong. But what do you think? Hey, do you think there's other risks I'm not talking about? Do you think there's other opportunities I'm not talking about? Put a comment in the comment section. I'd love to respond to anything I see in there personally. And if you like this content, it'll be coming to you about once a week with thoughts on what's coming out of the White House, what's the market's reaction to these sorts of policies, what's going on with the Fed, what's going on in other markets. And so hit that subscribe button. You'll be the first to know when we have a new video. I'd love to see you again.